Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today I'm joined by David Blanchett. He's head of retirement research at PGIM DC Solutions. Doesn't roll off your tongue, David.
That's okay.
But that's where you're head of
That's
retirement research. So David, I want to start here. It's not the sort of question that pre-retirees and retirees ask per se in these words, but often they want to know how to build an efficient portfolio. So walk us through that. How would someone go about doing that?
I'm going to try to do this without using any acronyms or fancy words. But at a high level, I worry about people doing it themselves. I think that, trying to find someone to help you do it's really important. But let's take a step back and how do I think about it? Well, when we're building portfolios for someone who's in accumulation, someone who's younger, I don't want to say it's pretty easy, but you want to maximize return for some given unit of risk. Okay, so that's pretty straightforward. There's ways to do that are very common. Where things get, I think, a lot more interesting is you get into retirement because we have to worry about lots of different risks. The risks about living your money, inflation risk, sequence risk, and then there's all these unique preferences that retirees have. They want to have income in a portfolio. They don't want to worry about missing out. And so I think that's where things get really tricky. And at a high level, the key is diversification, but kind of by definition, the efficient portfolios, the optimal portfolios you might build in retirement can just look very different for each person based upon what they're trying to accomplish.
Yeah. So when I think about efficiency, when you're saving for retirement, oftentimes people talk about account location.
Sure.
And then asset location within those accounts. And sometimes people will say, you should put your fixed income securities in your pre-tax accounts, IRAs and 401ks, and your growth stocks in your taxable accounts or in your Roth IRAs or Roth 401ks. Is that where you fall on that advice, or is that too generic?
It does. So that's kind of the next level down. So I would call that creating what's called tax alpha. How do you increase the after-tax rate of return that you experience as an investor? So at a high level, I think the first question to ask is, what is the right level of risky assets in my portfolio? So how much do I allocate to stocks, right? And then you think about, well, maybe I should own those stocks or own those different mutual funds or ETFs in different types of accounts. So, from a tax efficiency perspective, bonds or fixed income are relatively tax inefficient. So if you can put those into a 401k and IRA and own, tax efficient ETFs or mutual funds in your taxable account, you're going to increase your long-term rate of return.
Yeah. So when I think about that too, it's also begin with the end in mind, which is how am I going to get those assets out of those accounts in the most tax efficient manner? So is it fair to say that if you have a diversity of accounts, Roth, taxable, and pre-tax, that's the best way for people to sort of get ready for a tax efficient drawdown?
Yeah. I mean, if we think about retirement could last 20 or 30 years, right? And I wouldn't want to say you should have your 401k, for example, invested entirely in bonds and your Roth account entirely in equities. But a point that I make to advisors a lot is that if you have clients and they have a traditional IRA, a Roth IRA, and a taxable account, and you're investing all the accounts the exact same, you're not maximizing their after-tax return. So I think that there's extremes that you can take it to. I focus first on what is that right level of risky assets, and then thinking about how do you overlay taxes to kind of, again, maximize that after-tax rate of return.
Yeah, and not to micromanage this, but for many people who might be just starting out, they've just entered the workplace, they're saving for retirement in a 401k, they don't necessarily have a taxable account. The bulk of their assets is going into a pre-tax account. So How do they sort of balance this notion of fixed income?
Target date funds. I'm a huge fan of target date funds. It's a way to simplify the decision. If we think about taxes, the vast majority of Americans have almost all their savings in traditional type savings. It's all pre-tax. And so this notion of asset location, thinking about how to allocate across account types, that's important, but it's not a big issue for most Americans. I think that if you're younger, thinking about retirement, try not to build a portfolio yourself. I think that if you have a target date fund in your 401k plan, that is an excellent place to start. Now, as people get closer to retirement, though, what we see is they're less and less likely to utilize the target date fund for their investments. They want help. They want something more personalized to them. And I think that's where we can see kind of a wide diversity of recommendations around risk. I know that the other day you just posted a story looking at some research that suggested that, for example, retirees should have 100% of their portfolio in equities. Do you want to?
Yeah, so I wrote a column quoting some researchers, some academics from Emory University and other places where what they did was study what was the optimal portfolio in terms of building the largest nest egg, generating the largest amount of income in retirement, generating the highest probability of not outliving your assets and leaving the largest bequest. And what they came down to was you should invest 2/3 of your money in international stocks and 1/3 in domestic stocks. And I know that you posted this, I quoted you in the article, and then you posted it on LinkedIn, and there was a bevy of responses to that. And many of the folks said, sounds great on paper, but in reality, maybe not.
Well, so I've done almost the exact same analysis using the exact same data set, okay? And to me, there is this high-level theme where the longer you have to invest, the more aggressive you should have been historically. So yes, equities become more attractive the longer that you can kind of leave the money alone. But I have a hard time just kind of taking what's happened historically and extrapolating that into the future. So for example, they talk about international equities. Well, the correlations, the relationships among international markets have increased dramatically over the last 150 years. There's expenses to investing. There's behavioral issues. And so I think that, yes, there is this notion that risk isn't random over time and that long-term investors should be more aggressive. But I really don't think that retirees should put all of their money in stocks unless they meet kind of very certain criteria, like you're very risk tolerant, you've got tons of lifetime income, stuff like that. So I think that it was maybe an interesting academic finding, but my concern is that people will read that. I think that that's the right thing for them when it's not going to be the right thing to do for most retirees.
Yeah. So in the study, one of the interesting things from my perspective was this notion of them saying that bonds aren't necessarily that they're not a diversifying effect over the long term.
Right.
And is that fair to say that people have this mistaken notion that bonds are a diversification asset?
So there's this notion of this idea of like a randomness in returns. Okay, so there's a book called, everyone's maybe heard of it, A Random Walk Down Wall Street. There's fancier terms we can use called serial correlation, but we're not going to go there in this.
We have to decode that one.
But I think the key is that it's really important to think of, if I'm going to hold stocks and bonds, okay, how does the risk of owning those investments change the longer that I hold them? Okay, and historically, stocks go up, stocks go down, right? And so what happens actually with owning equities is that they become effectively less risky over longer time horizons relative to bonds, where the increase tends to increase. Now, an important point to note is that the risk of all assets increase over longer durations, but they increase at different rates. And so I think that the effect that they demonstrate, that I demonstrate, lots of folks have talked about this. Jeremy Siegel, Stocks for the Long Run, have just said that, hey, the longer that you can own stocks, they become more and more attractive. So even if someone who is relatively risk adverse, who doesn't like this idea of market volatility, they can just leave that portfolio alone. They're probably better off being a bit more aggressive owning equities than owning bonds.
So David, now it's time for a segment that we call Retirement Reality, where we ask real people real retirement questions. And have you thought about like how long you might live in retirement and how long your money might need to last?
Things like I don't know the future. Cause the future, like nobody know the future.
Right.
You just try to like build something for yourself.
Right.
Yeah.
The hardest part about retirement planning.
Yeah.
You don't know how long you're going to live.
You don't know how long you're going to live.
So, David, for me, the hardest part about retirement planning, as I said, is not knowing the length of your retirement. How does someone go about figuring out whether I plan for a year of retirement or 35 years of retirement?
So I know we're supposed to avoid like fancy terms, but longevity risk is this kind of widely discussed risk where the longer that you live in retirement, like the more expensive it becomes. And no one wants to retire and like die the next day. Like we want to have a long retirement, but the problem is that uncertainty of how long you're going to live, it just radically complicates what we're supposed to do and how much you're supposed to save. And so I think that one thing that hasn't been great for America is this movement towards defined contribution plans. And let me caveat that, just because it's really hard when you get to retirement to figure out how you're going to create a plan based upon all these idiosyncratic risks. So I think that longevity is a huge issue. I think it's really important to personalize your number. I've done some research looking at common assumptions in financial plans advisors use, and I am concerned by the fact that it looks like a lot of advisors out there, they don't spend the time to understand how long someone's likely to live. So I think that for those of you out there that are kind of like worried about longevity, it's a huge issue. One of the best ways to deal with that is to delay claiming Social Security, buying a lifetime income annuity, things like that. But I think it's really important to be aware of how long you're likely to live. And why that's so important for your listeners is that individuals who have money saved for retirement in the top maybe first or second income decile are going to live 3 to 5 years longer than the average American. And so if you don't get an accurate reflection of your longevity, I worry that you're not gonna be preparing for the appropriate potential length of retirement.
Yeah. So a lot of financial planners that I talk to use age 95 as the planning horizon, which may mean that for many people, they'll have enough assets to live that long. But for others who die sooner than that, they'll just be leaving a larger bequest to their heirs.
Yeah, and I mean, I like age 95 as a starting place, but for the average couple who has reasonable savings for retirement, male, female, age 65, there is a 50% chance today that one will live longer than 95 years. And so I'm not suggesting that you be overly, conservative in your assumption and use age 100, but there's also going to be some folks that aren't very healthy and for whatever reason should use 85 or 90. And so again, 95 is not a terrible starting place, but I really think it's important to go online. There's tons of free online tools and just kind of get a better sense of how long retirement is likely to last for you based upon your situation.
Yeah. David, I know we could talk for hours. I know you've done so much more research that we could talk about that we didn't get to. So maybe you'll come back on a future episode and
Sure.
we can talk more about that. But in the meantime, I want to thank you for sharing your knowledge and wisdom with us. It's
Sure
much
thing.
appreciated.
Great seeing you.
Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today I'm joined by Doug Boneparth. He's the president of Fide Wealth. Doug, welcome.
Hey, how you doing?
We're old friends.
Yeah.
Glad to have you here. I want to start here, Doug. We'll talk about going behind the headlines. And
Sure.
the world spends a lot of time watching the Fed, wondering about interest rates, wondering about short-term rates, long-term rates, mortgage rates, credit card rates, et cetera, et cetera. So what should those saving and investing and living in retirement focus on when they think about the Fed and interest rates?
Yeah, sure. So if we have retirees, we're talking a lot of fixed income, right? We're talking about more conservative investments. Depends, but typically that's what we think. So a rate environment's particularly, important to retirees. Also, I don't know how much borrowing they're doing, but certainly on the savings side, it's important. But when it comes to borrowing as well, it's going to have an impact. I think it affects everyone, no matter who you are and what stage of life you're in. The rate environment is critical.
Yeah, so for those who are saving for retirement, whether they're 20 or 50, what do they need to think about when they think about the Fed and interest rates?
Absolutely. So for most of my clients that are older millennials and, even on down to Gen Z, a lot of this has to do with borrowing and affording homes and things that are pretty important at the phase of life where big things happen, right? I call your 20s and into your 40s that period of time. So particularly around housing, which is proving to be quite the challenge for younger investors and clients even getting into the housing market.
Yeah. I mean, so you're talking about young folks, and I often think that there are competing financial goals, right? They may be saving for retirement. At the same time, they're saving to buy a house. At the same time, they're saving to buy a car or get married or have children and fund college.
Oh, yeah.
Talk a little bit about how you
Sure.
manage these competing goals.
Absolutely. So we talk about goal priority. So it's not just enough to specify what your goals are. I think that's a great starting point. So identifying what your goals are is critical. But then you also need to quantify them by time and value. So that's step 2. So when do you want to achieve this goal and how much is that goal going to cost? Something like a house or a car, that's more easy to calculate than retirement, which has a lot of other assumptions going on for it. But the third component, which I'd argue is maybe the most important one, is what's the priority of that goal? Because to your point, you have competing goals, right? So if you're honest with yourself, whether it's paying down student loans, saving for a home, saving for retirement, your kids' college, we can go on, you're not going to be able to get them all done at the same time. So we need to know which is going to take the first and last dollar of available savings so you can invest towards those goals. And that might require sacrifice, but I think it's an honest conversation with understanding what's most important to you. And that's what makes personal finance personal. You're not wrong or right for choosing one goal over the other, right?
Yeah.
I could point to plenty of clients that have prioritized paying down their student loan debt before ever thinking about a house, as well as the exact opposite of that.
Yeah. But when you think about people's individual facts and circumstances and what they prioritize, they might be doing things that are contrary to what good financial planners might suggest that they do.
Yeah, so there's something out here, at least in terms of my thinking, that I think most people would say you should do, but I'm kind of keen on not doing. It's
The world is filled with shoulds, by the way,
yeah,
right?
again, personal finance being personal. I think it's crazy to think that one way of going about living your financial life is correct or wrong. I mean, this is as subjective as it gets, but I'll give you a good example here. Many people think that the sooner you can invest money in the market, the better off you're going to do. Yes, of course. I think if you have time on your side, you're going to
Eighth
come.
the wonder of the world,
Yeah,
compounding. Right.
exactly.
Yeah.
But I would also argue, what good is investing your money if you can't stay invested to enjoy compounding your returns? So what does that mean? That means having solid fundamentals, a really good foundation. That has everything to do with probably the most boring thing, cash. So that's the emergency fund. That's really being intimate with how money comes in and out of your life. So mastering your cash flow. So if we're not taking care of these foundational components around cash before we get to investing, what tends to happen is something will come along in your life because it's fickle. And then you have to interrupt the investment that you're doing. And it's all for naught. You do that at a bad time in the market. And now you've gone ahead and shot yourself in the foot. So there's something that's a little counterintuitive as far as, hey, you got grandma or mom and dad, you get money in your 401k right now. Yeah, get that match. I agree with that. But set yourself up for success so you can be a great disciplined investor.
Yeah, we're going to talk more about financial literacy in a bit, but one thing that sort of strikes me is this notion of, as I'm prioritizing, let's say I have a credit card debt out and I'm paying 18% interest.
Yeah.
And I'm saving in an account that might be earning 8%, but there's a mismatch there, right? I should be paying down the credit card debt before I invest.
Yeah, I want that account that's paying me 8%. I assume you're taking some risk on that. But to your point, you have something like credit card debt where you're being charged 18%. I mean, that's straight up toxic. You're going to attack that first. You're going to get that off your plate above anything else. You got 18% there. There's nothing out there that's going to be as good or higher than that you can do consistently. I call this working backwards financially when you have a credit card debt or any kind of debt commanding double-digit interest rate.
Yeah. So when you think about young people who are entering the workforce, they have a salary for the first time. Is managing debt sort of the first, generally speaking, the very first priority? Because so much of your, people do debt to income ratios and figure out
Yeah, I think if you're coming, into your adult life and the first thing is you're got a spending problem or you're, unable to live within your income, and granted, there's a question around what you're doing and what that job may provide you as far as income goes. If that's the first, hurdle here, then yeah, we got to go right to the fundamental part of personal finance, which is getting spending under control, right? So, I think we want to hopefully work with people that are beyond that, but a lot of times we can see that there's some issues around spending, and you want to get that licked as soon as possible.
Yeah. Doug, it's now time for a segment that we call Retirement Reality, where we ask real people real retirement questions.
Sure.
Take a look.
You mentioned your husband sort of being the money master in the family. Do you have a desire? Like oftentimes women sort of delegate that to their husbands. Do you feel like you need to know about it, that it would be helpful to know, or are you happy to delegate it?
No, I like to know about it myself, and we talk a lot about it. He always lets me know the things that he's doing, like with our finances.
So, Doug, I know you spend a lot of time talking about helping households deal with money conversations, partnerships, I think you call them.
Yeah.
What do you think?
Yeah, so I think we should always be consulting our significant other around financial decisions. I think that's a good thing to do here. But what I strive for is creating fairness and equality inside households when it comes to finances and money. What I'd love to see is everyone, and she may be on the same page with her husband or not. I don't know enough here. But what we're striving for here is everyone knowing at a minimum where your assets are, knowing what income is being generated, having an idea of what the household expenses are, both having access to accounts, right? You should have the same apps on your phone. So the more we can create an equal playing field, For households, the better off we're going to be. The great part about being a financial planner and putting forward financial plans for clients is that process does a very good job of getting everybody on the same page. So by getting kind of household participation around this, we really do increase the probability that you're going to hit your goals together. And we also do create that fairness and equality inside the household. And I think that's very important for relationships and marriages particularly. And I think it's actually wonderful for striving towards goals that you have together. This is a team game you're playing.
Team sport?
Absolutely.
Yeah. So what about like in cases where someone says, I want to do the day-to-day management of our household budget and the checking account and paying the bills.
Yeah.
And I'm going to manage the investments, but we're going to sort of meet on the weekends and maybe discuss what happened that week with our money.
Yeah, there's no right or wrong way as far as the division of labor goes when it comes to who's doing the day-to-day stuff in the household, right? I'm a financial advisor, or, I do this for a living. Why would my wife want to do the day-to-day? But it would be completely unacceptable for her not to know where the accounts are, where they're located, how to access them, what our net worth looks like, what spending looks like. My wife actually works with me, which is great. So she needs to even understand mechanics around the business, right? These are things that, again, create that equality. So if someone's doing the day-to-day, fantastic. What I do is meet with my wife on a quarterly basis. We go through net worth. We take a look at how we're doing, and we actually have a real conversation around what's going on behind those numbers, right? Numbers only tell you so much of the story. How about what our goals are? What did we do well this year? Is there anything that we feel we need? Do we feel free to spend?
Yeah.
You want to check in with these very qualitative components in addition to the actual mechanics of your financial household.
All right. So you mentioned your wife a little bit ago that she's working with the firm.
Yeah.
And that you and she are now writing a book called Money Together.
Right.
What will people learn once this book is published?
Absolutely. Ultimate goal of this book is to create fairness and equality amongst partners, specifically when it comes to money. We have 5 sections in the book that we're going to allow you to have productive conversations with your significant other. This isn't a book about how to set up a joint account and what goes where. No, this is how you can be seen and see your partner when it comes to their origins and what their money scripts were growing up, be able to uncover what their mistakes were, right? Have a conversation about caregiving, right? It's more than just the kids, it's parents as well that you might have to take care of. And we'll have a productive conversation around power and risk. So these 5 sections should get anyone into a position to have those conversations so you can become an unstoppable financial team. You said earlier, like money is one of these games. It never ends. You play it your whole life and it's constantly changing and constantly evolving, right? It is tricky. It's almost cliche at this point to say that most relationships don't work out due to something financially related. Well, if that's the biggest issue in the long-term success of relationships, we should be addressing that. Healthier relationships mean more happiness, mean happier children and happier families. And I've yet to see anyone really put their arms around this topic in this way.
All right, Doug. So I want you to come back on the show and talk about the book
100%.
when it's published. I want to thank you for sharing your knowledge and wisdom with us. It's greatly appreciated.
Anytime. It's really good to see you.
If you've got questions about money or retirement, email me at askbob@yahooinc.com, and we'll do our best to answer your questions in a future episode. So that's it for today's episode of Decoding Retirement. We hope we provided you with some actionable advice for saving for or living in retirement. And don't forget, for the latest retirement news and expert analysis, check out yahoofinance.com.